commissions were $7.6 million, marking an increase of 13% when compared to $6.8 million in the first quarter of 2019. Now, to give you an idea of the current market rate, we recently triggered the fixed rate option in one of our time charters for July and August, locking the vessel at a rate of $19,250 per day. This corresponds to approximately $1.2 million in net operating revenues, or about 16% of the net operating revenues earned by our whole fleet for the full first quarter. So, a single vessel will generate in 2 months 16% of our entire operating revenue for the first quarter. Moving on to the expense side, operating expenses for the first quarter were $5.1 million, increased from $4.4 million in the first quarter of last year, mainly due to the timing of certain payments. Nonetheless, the figure is comparable with the $5.1 million operating expenses incurred in the fourth quarter of 2019. At the same time, general and administrative expenses were down by 19%. EBITDA in the first quarter of 2020 was approximately $1 million, up by 130% compared to an EBITDA of $430,000 in the same period of 2019. The improved commercial performance of our fleet resulted in higher net operating revenues, offsetting the marginal increase in operating expenses. Interest and finance costs in the first quarter of 2020 amounted to $5.7 million, a decrease of 9% from $6.3 million in the first quarter of last year. Of this amount, cash interest expense represented about $4.2 million, marking a reduction of 11% compared to the corresponding amount of $4.8 million in 2019. On the interest front, we are marking year-over-year improvements through the last 3 years. As a result of the above variations, net loss for the first quarter of 2020 was $8.3 million as compared to a net loss of $8.6 million the same period last year. Now, turning to our balance sheet, as of the end of the quarter, Seanergy had $6.2 million in cash and cash equivalents, and shareholders' equity was equal to $21.9 million. The effect of the recent capital raising activities will reflect in our 6-month balance sheet, translating into much stronger shareholders' equity position and solid cash reserves, and this after having fully absorbed shortfalls from the low earnings environment up to June. Now, having said this, I would like to note that the series of equity raisings that took place in the second quarter of the year came in response to the extreme levels of macroeconomic uncertainty that prevailed at the time when global industrial and economic activity was halted. Our primary aim has been to strengthen our balance sheet and ensure the smooth continuation of our fleet operations. So far, we have emphasized on maintaining liquidity and the flexibility to respond to the rapidly changing and highly uncertain market conditions. If the recent improvement in the dry bulk market proves to have any durability, as we expect it will, we would not rule out shifting emphasis on the deleveraging of our balance sheet through unlevered or low-levered vessel acquisitions. This would eventually contribute to an expansion of our scale and operating leverage as a leading pure-play Capesize platform. Lastly, I would like to provide some color on the ongoing discussions with our lenders for the upcoming maturities on 2 of our senior secured facilities. The first is in June 2020, and the amount outstanding is approximately $29 million. We are currently in process of finalizing an agreement to refinance the loan in a way that will create accretion for our investors whilst reducing the break-evens of the underlying vessels. Considering the proximity of the maturity, we regret that we are unable to share more information today, yet we will be in a position to provide further details about the agreement in due course. Unfortunately, the COVID-19 situation has increased the processing time for most banks these days, and thus the delay in concluding our arrangements. At the same time, we're having constructive discussions with our lenders with the aim to reach an agreement on the second and last facility expiring in 2020, way ahead of the December maturity. I would like to reassure our shareholders that based on the proactive capital raising actions that we took during the first half of the year and the improved market conditions since the start of June, we are on the right track to address successfully the upcoming maturities. This concludes my review of the financials. I will now turn the call back to Stamati, who will discuss the market and industry fundamentals before concluding with his final remarks. Stamati?
Thank you, Stavro. Moving on to the industry outlook, as we mentioned at the beginning of our call, the Capesize sector was severely affected in Q1 by a combination of negative factors. The main factors were the unusual severe local weather disruptions, especially in Brazil, and of course the outsized impact of the COVID-19 pandemic worldwide. As a result, iron ore exports were considerably lower than expected at the start of the year. However, as mentioned earlier, since the beginning of June, Capesize market has performed exceptionally well, and the BCI levels have improved enormously from a daily level of about $2,000 per ship per day to more than $28,000 per ship currently. Consistent with previous years, high volatility and seasonality are normal features of the Capesize market and should not distract us from the positive overall fundamentals. Notwithstanding the difficult start of the year, seaborne iron ore ton-mile demand is expected to rise by about 0.3% in 2020 compared to a contraction of about 3% in 2019. As mentioned before, the global governments of China and the United States have put enormous stimulus in place in order to jumpstart their economies. Furthermore, bauxite volumes, which rose by more than 10% in 2019, are expected to rise by similar levels in 2020 and thereafter, and continue to support demand for larger vessels through long-haul voyages out of West Africa. Looking further towards the next 2 years, the eventual full resumption of Vale iron ore production could add more than 60 million additional tons of long-haul Brazilian exports. That is on top of the current guidance of 320 million tons. These levels alone would be enough to sustain a healthy Capesize market in the future without even factoring in any further growth drivers such as the explosive growth seen in the seaborne trade of bauxite or the possibility for further iron ore mines expansions in Africa and Brazil. As regards to fleet growth, there are a number of reasons to be optimistic as the Capesize order book is at historical lows. As mentioned in more detail in our previous earnings call, the International Maritime Organization regulations regarding CO2 emissions are bound to become very restrictive from 2030 onwards, and the uncertainty around new vessels and engine designs makes it very hard for ship owners to commit to new investments. This is also clearly reflected in the lack of availability of financing for new projects. We are confident that the positive supply outlook sets the stage for continued strong market performance, and this is evident by the resilience of the Capesize rates even during the highly uncertain macroeconomic environment over the last 2 years. Seanergy's emphasis on the improvement of the fleet's environmental efficiency and the established long-term relationships with prominent charterers ensure our fleet's continued commercial success. As a closing remark, the Capesize vessels are once again outperforming the rest of the dry bulk market by far. Seanergy is the only pure-play Capesize company listed in the U.S. capital markets, with all of our ships taking advantage of the soaring market conditions. Moreover, our strong balance sheet will allow us to capitalize on attractive opportunities at historically low asset values and deliver highly accretive transactions to our shareholders. On that note, I would like to turn the call to our operator and answer any questions you may have. So, Jody, please take the call.
Thank you very much, sir. Ladies and gentlemen, if you wish to ask a question, please press *1 on your telephone keypad and wait for your name to be announced. Our first question for today is from the line of Tate Sullivan. Please go ahead.
Hi, thank you, Tate Sullivan from Maxim. Thank you for the comments. Can you give more, you mentioned it before, but can you give more background on the decision for the timing specifically of the stock split, the reasons for timing it now, please?
Well, Tate, of course. First of all, as I mentioned, our stock had dropped a lot during the first quarter. It had nothing to do with the offerings that we did. It was just a result of where the overall market was going. We decided to do it now, even though we have another quarter basically ahead of us. And we decided to do it now so we provide a clear runway for the investors and in order for our stock price to reflect what we believe to be the true value of our shares. I mean, we don't really think we deserve to be hovering between 20 and 35 cents. I mean, this is a company which is worth much, much more than that, and we want that to be reflected in our stock price. We decided to do it now that the market has recovered significantly, and everybody joining the company now will take advantage of the whole thing.
Okay, thank you. And a couple more for me, please. Looking back on the 1Q results and currently, did your spot rates hold up better than the index rates would suggest? It just seems your time charter equivalent was more resilient during severely low rates than I expected. And if you can comment on how they can hold up a little better than what we saw the index do in May as well, too. Any dynamics there?
Well, that's actually a very good question. To be honest, there's no magic answer to that. We had a lot of ships coming in the first quarter from the Q4, which was fixed at substantially much higher levels. That's why we were able to produce almost 60 or 70% higher rates than where the index was. However, of course, at a certain point, the reality kicked in for everyone. The COVID situation together with all these negative factors we explained before, and it came to a point where we had to face the market ourselves as well. Right now, of course, the market has gone up, as I mentioned before, almost 700%, and I think it's going to remain at much higher levels for the second half of the year. Therefore, the cash flows of the company, as they were last year, in the second half will be, multiple times the ones of the first half of the year.
Okay, thank you. And in the current environment and for this current quarter, and with the rates already improving so meaningfully, what other operating expenses can you cut in the current market?
Well, we don't have any other. I mean, the good thing about our fleet is, first of all, we have almost 0 dry dock days. So having completed all our dry dock schedule in 2019, the majority of our fleet, if I remember well, 9 out of 10 cases, we will be dry dock free until the end of the year. That means that we will hopefully be taking advantage of, full advantage of the stronger market from now until the year end. So no additional expenses, no additional capex. We expect from now and from the beginning of June until the end of the year to have a very clear runway on, a very healthy revenue stream.
Okay, thank you. And the last one for me, please, is you mentioned the improvement in your balance sheet. Can you give some historical context on, for instance, when was your last acquisition, and was it as you move forward, will you look more at new builds, even though the current order book is at a historical low you mentioned, or current ships, or can you give any more context there?
Yes. Even though the market has seen a very high increase in rates, there are still some amazing acquisition opportunities for someone that is willing to get in and buy additional assets right now. I cannot comment any further on that front, but watch this space. That's all I can say. The good thing here is that it's very hard to make any predictions for new buildings because the new regulations have not any clear outlook as to what the future ship is going to be. So the real value right now in the Capesizes lies with the second-hand ships, and this is what has been always the best solution for Seanergy, and this is how we've made our most accretive transactions so far.
Okay, thank you for all your comments. Have a good rest of the day.
Thank you.
Thank you very much. Our next question is from Poe Fratt. Please go ahead.
Morning, Poe Fratt from Noble Capital Markets. Christos, you highlighted that you raised $30 million through the middle of May. Can you highlight how much additional capital came in through the exercise of the warrant?
Paul, I will pass. First of all, the answer of that to Stavros to give you. Let me give you the call to Stavros, and he will answer. Hello, Paul. Actually, the exercises is an ongoing exercise which has not been finalized yet, and we expect to reconcile that in following updates, together with some ideas that we have for the potential use of the proceeds are coming out of the warrants. But it's in the region of 15+ million.
Okay, great. And so when if you look at cash at the end of the first quarter of 6.1 million, do you have a pro forma estimate for cash that would correlate to the table that you have in the press release on your, pro forma adjusted capitalization table?
Well, that's why we have put a very generic capitalization table out there so people can do the math. I cannot really say right now, Paul, because there are certain important transactions that are going to be finalized in the next few days. So I don't want to give a pro forma figure that may change substantially. So I don't want to give you a pro forma number just for the offerings. There will be additional positive effects to our capitalization after these transactions are consummated, but I cannot really comment right now. It's going to be very soon, though.
Just to be clear, those are from the refinancing of the $29 million of debt that's due at the end of the month or due now?
Not just that. Some other things as well, which we cannot really comment.
Okay.
But they're not associated with offerings. They're associated with some deals that the company has managed to execute and that will be announced in due course very soon.
That's helpful. And you talked about locking up for July and August at $19,250. Can you talk about any other opportunities that you have to lock in what are attractive rates near term?
We have, and we have already started locking in some of the ships for July and August. We're constantly monitoring the market right now, so we've already started with one or two of our ships. The signals that we're getting is that the market is going to shoot up even further, so we don't want to miss the upside, having had a very tough first 5 months of the year. So we are cautiously monitoring the markets. We're ready to pull the trigger. We have this flexibility from our index-linked charters to convert into fix. So we're taking a very cautious step, and monitoring the whole circumstances on a daily basis to do additional ships.
Okay. So do you have a figure right now for the third quarter on, where, how much forward cover you have right now?
Well, I don't want to give a figure because the market has been shooting up so much, and we have some spot charters that are yet to be finalized. So I don't want to give a figure because, the majority of the fleet is index-linked. So, it moves with the index on a daily basis. We have some conversions, like, as I mentioned before, to some fixed, but I don't want to give a clear outlook yet because, again, there are certain things that need to be developed, but it's, of course, at substantially higher levels than, what we did in the first half of the year, multiple times.
And could you, since the second quarter is almost done, can you give us an idea of where your TCE rates will average for the second quarter? And then also, Stamatis, if we could just clarify, it seems like part of the premium, it looks like the premium versus the BCI in the first quarter was, $3,912. Part of that is the recovery of scrubber investments. Is that correct? And do you have an idea of, how much of that outperformance is, the recovery of investments on the scrubbers for the, the fleet that's outfitted with scrubbers?
Yes. Like you very well said, I will start with the second part of your answer. The answer is yes. We have had an important recovery as 4 of the ships were making a significant premium due to the scrubber premium that we are getting from the charters. As for the second quarter guidance, as I mentioned in the call, April and May were also weak months. However, the soaring levels that we saw in June have not been able to make the right calculations yet to see what the effect is going to be for the second quarter. That's why I cannot give you guidance yet. We're still finalizing the cutoffs and the numbers, which we still have 4 days in the quarter. And that's why I don't want to provide a guidance because the increase has been so steep, so fast, that it really caught us. All this incremental revenue has kind of caught us by surprise. That's why we cannot really give you an answer. And there are a lot of cut-off and accounting issues that need to be discussed before we provide a guidance. That's why I don't want to be held up in a guidance level right now. So it's been a great month, June. It was not so great in April or May due to the fact of the prolonged crisis. So that's why I don't want to give a guidance right now.
Okay. It's always good to have a surprise that's positive once in a while. Can we focus on OpEx a little bit, and where OpEx was up in the first quarter just because of the timing of expenses. Can you give us an idea of where OpEx will be for the rest of the year? And then also, if we could look at the first and possibly the second quarter, what kind of working capital changes did you see? And then also, what CapEx numbers should we be looking for in the first and second quarter of the year?
Thank you, Bob. This is Stavros. First of all, on the OPEX front, the OPEX for the first quarter was inflated with one-off expenses having to do with the release premiums on certain of our vessels because we decided to change hull underwriters. Now, going forward, you should expect, our operating expenses to normalize to the levels that you used to, around 4.5 to 5 million per quarter for the entire fleet. Moving over to the dry docking expenses, as discussed in the past, we had one ship that went through dry docking in the first quarter next to her scrubber installation. The cost of the scrubber installation and the associated of hires was covered by the charterer, which was Glencore. So the overall capex that was left for Seanergy was around $500,000 to $750,000.
Okay. And do you have an idea of how working capital changed over the first quarter and possibly over the second quarter?
Working capital over the second quarter was drastically reduced. We were able, through the proceeds of the offerings, to reduce lots on the working capital, and this has normalized to the levels, to levels of $500,000 to $1 million per vessel, which is very normal, considering that our fleet comprises Cape-size vessels.
Okay. And then, Stamatis, if we could just look at you just indicated that you potentially think that the market is going to tighten even further. What, we're sitting at 30,000 as far as Cape rate. What do you think could go right from here? And then also, what do you think could go wrong from here?
Well, the obvious answer for things that can go wrong are pretty much the same things that went wrong from in the beginning of the year. It has to be weather-related disruptions, as well as the COVID pandemic. However, if I may say, the dry bulk and especially the Cape sizes are what we believe to be the more resilient in this kind of circumstances, because the first thing that any government is doing in order to boost the recoveries of their economies is the infrastructure spending. So, we're not affected by, let's say, the planes or traveling or things like that. They will build more roads, they will build more houses, they will build all that to achieve the spacing and also to jumpstart their economies. In the US also, it was announced recently $1 trillion of infrastructure projects, and that is only helpful for the Cape sizes because we transport iron ore and coal, which is then converted into steel. So, it's one of the most resilient sectors to be in right now. So, things can go bad if COVID outbreak, pandemic becomes a major issue again towards the end of the year. We certainly hope that this doesn't happen. Not for the rates, of course, but for the health of the global population. And number two, the weather disruptions that always are an issue in the northern export system of Brazil. And right now things are appear to be quite normal. Things that can go well is, the additional imports of China in order to recover and restock the inventories of iron ore, which, you know, the demand is particularly strong, and that's why the iron ore prices have gone up, and the aggressive and massive investments in infrastructure that are expected to happen, and they will lead the Capesize rates to go even further up. So that's all I can say. All that, of course, with a reduced new building schedule, which appears to be kicking in now, and you know, providing very strong fundamentals for the Capesize market.